This is the story of Bear Stearns, one of the best Wall Street investment banking firm, and how they collapse. It was Thursday evening, March 13, 2008. Outside the headquarters of Bear Stearns at 383 Madison Avenue, the first hints of spring were touching Manhattan. Inside, the air conditioning hummed against a different kind of chill. The cold sweat of institutional panic. The Dow Jones Industrial Average stood at 12,110, down 7.2% for the year. The S&P 500 hovered at 1,315. Federal Reserve Chairman Ben Bernanke had just cut interest rates to 3%. Bear Stearns stock had closed at $30. Down from $93 just 6 weeks earlier. Down from $172 a year ago. The stock had hit an all-time high of $171 in January 2007. But the stock price told only part of the story. What was happening in the shadows was far more terrifying. In the overnight lending markets, in the corridors where counterparties whispered doubts, in the email chains where hedge fund clients quietly moved their accounts. The board of directors convened by phone that evening. Among those listening was James Cayne, the chairman who had stepped down as chief executive just 2 months earlier. He was calling in from Detroit, where he was competing in a bridge tournament. Alan Schwartz, the new chief executive, was in Palm Beach trying to reassure investors. The firm that had survived the Great Depression, World War II, the 1987 crash, September 11, and every other crisis since 1923 was running out of cash. In 72 hours, Bear Stearns would cease to exist as an independent company. The price was $2 per share, later raised to $10. The buyer was J.P. Morgan Chase. The facilitator was the Federal Reserve, which would provide a $30 billion backstop for Bear's most toxic assets. For an institution that prided itself on scrappiness, on being the fighter from the outer boroughs in a world of aristocratic investment banks, the end came with shocking speed. The question that would haunt Wall Street for the next decade was not just what happened. It was how did no one see it coming? To understand Bear Stearns' collapse, we must first understand its rise. A story that begins not in the panic of 2008, but in the optimism of 1923. When 3 ambitious men opened a small equity trading house in Lower Manhattan and built an empire on a foundation of grit, risk-taking, and an unshakable belief that being tougher than everyone else was enough. May 1, 1923. Warren Harding occupied the White House. The United States economy, having emerged from the brief but sharp recession of 1920 to 1921, was roaring back to life. Economic growth for 1923 would reach 6.4%. The New York Stock Exchange was in the early stages of what would become the greatest bull market in history. The Dow Jones would climb from 100 in 1924 to 381 by September 1929. The 1920s economy was being transformed by new technologies and new forms of capital. The automobile was remaking American geography. Radio was creating national markets for consumer goods. Electricity was revolutionizing manufacturing. The stock market, once the province of wealthy individuals and banking houses, was opening to the middle class. Trading volumes on the New York Stock Exchange had doubled between 1921 and 1923. From 200 million shares annually to over 400 million. Wall Street in 1923 was dominated by white shoe firms with roots in the 19th century. J.P. Morgan and Company, the aristocracy of American finance, handled bond underwritings for governments and the largest corporations. Kuhnleb and Company, Goldman Sachs, and Lehman Brothers, all founded by German Jewish immigrants, served corporate clients and had begun building retail brokerage operations. These were firms of pedigree, where partnership was inherited or granted only after decades of service. Investment banks in this era performed several distinct functions. They underwrote securities, corporate bonds, and stocks, taking on the risk of purchasing an entire issue and reselling it to investors. They advised corporations on mergers and capital raising. They traded securities as principals, using their own capital. And increasingly, they served retail clients, individuals who wanted to participate in the stock market boom. The regulatory environment was minimal. The Federal Reserve, created in 1913, focused primarily on commercial banking. There was no Securities and Exchange Commission. That would come after the crash. Margin requirements were determined by individual brokerages, often allowing investors to buy stocks with as little as 10% down. Market manipulation was commonplace and perfectly legal. Into this world of opportunity and minimal oversight stepped three men with $500,000 in capital and significant ambition. Joseph Ainsley Bear was 53 years old in 1923, a veteran of Wall Street who had spent his career in the securities business. Little is recorded about his early life, but by 1923 he had accumulated enough capital and connections to anchor the new firm. Robert B. Stearns brought trading acumen and market relationships. The details of his background have faded into history, but his contribution was substantial enough to merit equal billing in the firm's name. Harold C. Meyer was the third partner, a trader who understood the mechanics of the equity markets. Together, the three men represented different aspects of what would become Bear Stearns' DNA: capital, relationships, and market savvy. The $500,000 in founding capital, equivalent to roughly $9.2 million in today's dollars, was substantial but not extraordinary for the era. What distinguished the early Bear Stearns was not size but focus. While the white shoe firms concentrated on underwriting and corporate finance, Bear Stearns positioned itself as an equity trading house, buying and selling stocks for customers and for its own account. From the beginning, the partnership was volatile. Internal tensions erupted among the three founders, including at least one instance of public physical confrontation. The firm nearly dissolved in its first years. What held it together was the profitability of the business and the expanding market. By 1925, the Dow had passed 150. Trading volumes continued to climb. And Bear Stearns, small and hungry, was capturing a growing share of the action. The firm opened its first office at 1 Wall Street, in the heart of the financial district. The staff numbered 7. The business model was straightforward. Execute trades for customers, take positions in promising stocks, manage margin accounts for wealthy clients who wanted to leverage their capital. It was a good time to be in the stock market business. By the summer of 1929, euphoria had overtaken Wall Street. The Dow stood at 381, having risen 300% in 5 years. Stock tips dominated dinner conversation. Ordinary Americans, teachers, shopkeepers, factory workers, borrowed money to buy stocks on margin. The prevailing wisdom held that stocks had reached a permanently high plateau, as economist Irving Fisher famously declared in October 1929. Bear Stearns, now 6 years old with approximately 75 employees, had grown substantially. But the partners had maintained a conservative approach to leverage and margin lending. When Black Thursday arrived on October 24, 1929, and the market began its catastrophic descent, Bear Stearns' prudence proved life-saving. The crash was brutal. The Dow would eventually fall 89% from its 1929 peak, bottoming at 41 in July 1932. Trading volumes collapsed. Brokerage firms, overextended and unable to meet margin calls, failed by the dozen. By 1933, more than half the securities firms operating in 1929 had vanished. Bear Stearns not only survived, it thrived. The firm laid off 0 employees during the crash and continued paying bonuses. This was not altruism. It was strategic. The partners understood that skilled traders and client relationships were their only real assets. Keeping the team intact while competitors collapsed gave Bear Stearns a structural advantage that would define its culture for decades. As America descended into the Great Depression, economic output falling 26% between 1929 and 1933, unemployment reaching 25%, Bear Stearns found opportunity in the wreckage. President Franklin Roosevelt's New Deal, launched in 1933, required massive government bond issuance to finance infrastructure projects. Roads, dams, bridges, public buildings. The banking system, traumatized by thousands of failures, was awash in deposits but unwilling to make loans. Interest rates on government bonds were extraordinarily low. Long-term treasuries yielded around 3.3% in 1933. Banks needed safe, liquid assets. Bear Stearns saw the arbitrage. Buy bonds, sell them to cash-rich banks. The firm made its first substantial profits by aggressively trading government and corporate bonds nationwide. By 1933, the staff had grown from 7 to 75. Bear Stearns opened its first regional office in Chicago after acquiring the Chicago-based firm Stein Brennan. This established a pattern of geographic expansion that would continue for decades. In 1933, Bear Stearns hired a 25-year-old former Salomon Brothers runner named Salim Listener Lewis, known universally as Cy Lewis. It was one of the most consequential hiring decisions in Wall Street history. Lewis was born in Brookline, Massachusetts, in 1908 to Orthodox Jewish parents who had immigrated from Eastern Europe. His father, Max Lewis, was 46 when Cy was born. An older father who had changed his surname from something unrecorded to Lewis upon arriving in America. Cy attended Boston University for 3 semesters before dropping out due to financial constraints. To earn money, he played professional football on weekends. Left guard, $50 to $75 per game, despite suffering from asthma. In 1927, he moved to Philadelphia briefly to sell shoes before finding his way to Wall Street. At Salomon Brothers, Lewis learned the bond business from the ground up. When Bear Stearns hired him in 1933 to direct its new institutional bond trading department, he brought ambition, street smarts, and an aggressive approach to markets that would define the firm's culture for the next 4 decades. Lewis became a partner in 1938 with a $20,000 investment, borrowed from his wife, Diana Borner Lewis. By 1949, he was named managing partner, running Bear Stearns' day-to-day operations until his death in 1978. His influence was so complete that 3 generations of Bear Stearns traders would describe their culture as Cy's culture. Hard-charging, meritocratic, and utterly indifferent to pedigree. World War II brought new challenges and opportunities. The federal government's wartime borrowing created enormous bond trading volumes. Bear Stearns, now firmly established in the government securities market, profited handsomely. The firm avoided the conflicts that had plagued the founding partners. Lewis's forceful personality kept internal squabbles to a minimum. In 1935, Congress passed the Public Utilities Holding Company Act, mandating the breakup of utility holding companies. As these behemoths were dismantled, new securities were issued for the formerly private operating companies. Lewis positioned Bear Stearns aggressively, trading at what he later called the most ridiculous prices you ever saw in your life. The firm's willingness to take positions when others hesitated became its signature. While the white shoe firms waited for book building and syndication, Bear Stearns bought bonds and stocks outright, marked them up, and sold them quickly. The approach required capital, nerve, and sophisticated risk management. Lewis had all 3. By 1948, Bear Stearns opened an international department. In 1955, the firm established its first overseas office in Amsterdam, followed by Geneva, Paris, London, Hong Kong, and Tokyo. This international presence was unusual for a mid-sized trading house and gave Bear Stearns access to capital and deals that eluded larger, more domestically focused competitors. In the 1950s, Cy Lewis was among the originators of block trading. The practice of buying or selling large positions in a single stock directly from institutional investors rather than executing them gradually in the market. By the 1960s, block trading had become the bread and butter of Wall Street. The mechanics worked like this. A pension fund or insurance company wanted to sell 100,000 shares of a stock. Rather than placing a market order, which would drive down the price, they would call a block trader at Bear Stearns. The trader would negotiate a price, buy the entire block using the firm's capital, then sell it piecemeal to other clients over the following days or weeks. The profit came from the spread between purchase and sale price, typically a few percentage points, but the risk was substantial. If the market moved against you, the firm's capital was on the line. Lewis excelled at this game. By the mid-1960s, Bear Stearns was one of the top block trading houses on Wall Street, alongside Goldman Sachs and Salomon Brothers. While maintaining its institutional focus, Bear Stearns began expanding its retail operations in the late 1960s. The firm opened offices in San Francisco in 1965, Los Angeles, Dallas, Atlanta, and Boston between 1969 and 1973. The strategy was to attract and manage accounts for wealthy individuals. Not the mass-market retail business of Merrill Lynch, but the private client service that generated steady fee income and provided a base of stable capital. These retail accounts also laid the foundation for Bear Stearns' margin operations. In margin trading, brokerage houses loan their client securities to short sellers, collecting interest on the loan. Bear Stearns would eventually manage approximately 300,000 margin accounts, a significant profit center. Under Cy Lewis, Bear Stearns developed a culture radically different from its competitors. Lewis famously looked for PSDS, poor but smart with a strong desire to succeed. Brooklyn, Queens, or Poughkeepsie. City College, Hofstra, or Ohio State. Jew or Gentile. It did not matter where you came from. If you could make money, Bear Stearns wanted you. This was a deliberate contrast to Goldman Sachs' preference for Harvard MB as Morgan Stanley's Old Boy Network, or Lehman Brothers family connections. Bear Stearns took pride in being the working-class fighter, the firm that valued results over resumes. The downside of this culture was its Darwinian brutality. Lewis ran the firm as a series of competing fiefdoms, each vying for his approval. Top traders could make millions. Those who failed were shown the door. The environment was profane, aggressive, and utterly focused on the bottom line. In 1975, New York City teetered on the edge of bankruptcy. The municipal bond market froze. Most banks and brokerage firms avoided city securities like toxic waste. But Cy Lewis saw opportunity. Bear Stearns invested $10 million in New York City bonds. A massive bet for a firm that had approximately $100 million in capital at the time. For months, it looked like a catastrophic error. The city slid closer to default. Bear Stearns' partners watched their capital evaporate. But in November 1975, the federal government and the state of New York arranged a bailout package. City bonds rallied. Bear Stearns' gamble paid off handsomely, generating returns that became legend within the firm. On May 1, 1975, May Day on Wall Street, the Securities and Exchange Commission eliminated fixed brokerage commissions. For decades, commissions on stock trades had been set by exchanges, providing guaranteed profits. After May Day, commissions became negotiable, and large institutional clients immediately demanded discounts. The change devastated many brokerage firms but played to Bear Stearns' strengths. The firm's focus on trading and client relationships, rather than pure commission income, provided resilience. Bear Stearns adapted quickly, using its trading expertise to generate profits from bid-ask spreads and proprietary positions. Alan Greenberg, known as Ace, joined Bear Stearns as a clerk in 1949, fresh from the University of Missouri with a business degree. He earned $32.50 per week. His uncle, a Wichita wheelman, had provided a letter of recommendation to 5 Wall Street firms. Only Bear Stearns offered him a job. Greenberg showed an immediate aptitude for risk arbitrage, buying and selling securities to profit from announced mergers, spin-offs, or other corporate events. By 1953, at age 25, he was running the risk arbitrage desk. By 1957, he was trading for the firm. He became a partner at 31. The same year he was diagnosed with cancer and given a 50% chance of survival. Greenberg survived and continued his ascent. When Cy Lewis suffered a stroke at his retirement party on April 26, 1978, and died 2 days later, Greenberg became chairman of Bear Stearns at age 50. Greenberg's leadership style differed from Lewis's volcanic personality but maintained the same core values. He kept his desk on the equity trading floor rather than in an executive suite. He answered his own phone. He was known for writing terse, sometimes brutal memos demanding cost savings. One famous memo proposed a ban on paperclips, suggesting employees use old paperclips they found on the floor. But beneath the cheapskate persona was a sophisticated understanding of risk and trading. Greenberg's risk arbitrage background meant he thought in terms of probability, edge, and position sizing. This discipline would serve Bear Stearns well through the volatile 1980s. The period from 1978 to 1993 encompassed some of the most dramatic transformations in financial market history. Paul Volcker became Federal Reserve Chairman in August 1979 and immediately moved to crush inflation, which had reached 13.3%. The Fed funds rate soared to 20% by June 1981. The S&P 500 traded sideways for 3 years. Two brutal recessions, 1980 and 1981-82, sent unemployment to 10.8%. But by 1982, inflation was broken, and the foundation was laid for a historic bull market. From August 1982 to August 1987, the S&P 500 rose 229%, from 102 to 337. Economic growth averaged for 0.5% annually. Corporate profits surged. And a new industry emerged: leveraged buyouts. The 1980s saw the rise of financial engineering. Michael Milken at Drexel Burnham Lambert pioneered the junk bond market, providing financing for corporate raiders like Carl Icahn, T. Boone Pickens, and Henry Kravis. KKR's buyout of A.J. Nabisco in 1989 for $25 billion became the symbol of the era. Bear Stearns participated in this boom, but never at Drexel's level. The firm's culture, trading-oriented, skeptical of leverage, kept it somewhat at arm's length from the wildest excesses. On October 19, 1987, the Dow Jones fell 22.6% in a single day. Still the largest one-day percentage decline in history. The S&P 500 dropped from 337 to 224, losing 33% of its value in weeks. Many feared a repeat of 1929. Bear Stearns, with its trading focus, took substantial losses. Numerous positions were eliminated. But the firm survived, and when the market recovered, the S&P 500 ended 1987 up 2% for the year. Bear Stearns was positioned to capitalize. On October 29, 1985, Greenberg and the executive committee announced that Bear Stearns would go public. The decision was driven by capital needs. The firm needed more resources to compete with larger rivals, and by the partners' desire for liquidity and succession planning. Bear Stearns created a holding company, the Bear Stearns Companies Incorporated, and sold 20% of the shares to the public. The initial offering priced at $20 per share, valuing the firm at approximately $400 million. Greenberg and other senior partners retained 80%, ensuring continued control. The public offering transformed Bear Stearns from a partnership into a modern financial services firm. The company reorganized into 5 divisions: investment banking, corporate finance, mergers and acquisitions, advisory services, institutional equities, block trading, equity research, institutional sales, fixed income securities, government bonds, corporate bonds, mortgage-backed securities, individual investor services, private client brokerage and wealth management, and mortgage-related products, a small but growing business in securitization. The additional capital allowed Bear Stearns to take larger positions, expand internationally, and compete for bigger deals. But going public also introduced new pressures: quarterly earnings reports, stock analysts, shareholder expectations. The private partnership's long-term orientation would gradually give way to Wall Street's quarterly mindset. In the late 1980s and early 1990s, Bear Stearns began building expertise in securitization. The process of packaging loans, mortgages, auto loans, credit cards, into bonds that could be sold to investors. The pioneer was Louis Ranieri at Salomon Brothers, who created the modern mortgage-backed securities market. Bear Stearns saw securitization as a natural extension of its fixed income business. The firm hired specialists, invested in technology, and began underwriting mortgage-backed securities for Fannie Mae and Freddie Mac. The business was profitable and growing. In 1992, Bear Stearns managed more than $13 billion in initial public offerings and securitizations. In the early 1970s, before Greenberg became chairman, Bear Stearns employed a corporate finance specialist named Jerome Kohlberg. Working under Kohlberg were two younger associates, Henry Kravis and his cousin George Roberts. Kohlberg, Kravis, and Roberts developed a new approach to acquiring companies: the leveraged buyout. They would identify undervalued companies, arrange financing, primarily debt, purchase the company, improve operations, and eventually sell for a profit. Bear Stearns, with its trading mentality, was not interested in this long-term, patient capital approach. As George Roberts later recalled, Bear Stearns was a trading firm with a trading mentality focused only on short-term profits. "We wanted to create value in these companies and hold them longer." In 1976, Kohlberg, Kravis, and Roberts left Bear Stearns to form KKR. They would go on to define private equity investing, culminating in the $25 billion R.J.R. Nabisco buyout in 1989. Bear Stearns missed one of the most lucrative investment trends in history because it stayed true to its trading DNA. By 1992, Bear Stearns was flying. The firm reported net income of $295 million, double the previous year's figure. The company had approximately 7,000 employees worldwide. The stock price had risen from $20 at the initial public offering to over $40. Greenberg's net worth exceeded $200 million. Bear Stearns had become a leader in government securities trading, mortgage-backed securities, risk arbitrage, equity block trading, prime brokerage, providing services to hedge funds, and global clearing, settling trades for other brokers. The firm's clearing business was particularly valuable. Bear Stearns processed trades for hundreds of smaller brokerage firms and hedge funds, earning steady fees while gaining insight into market flows. By the mid-1990s, clearing would generate nearly 20% of revenue. In 1993, Alan Greenberg stepped down as chief executive, remaining chairman, and elevated James E. Cayne to the position. It was an unusual choice that would ultimately prove catastrophic. Cayne was born in Evanston, Illinois, in 1934, the son of a patent lawyer. He attended Purdue University to study engineering but dropped out after 3.5 years when he learned he would need an extra year to retake a failed French class. After serving in the Army, he worked as a traveling copier salesman, sold scrap iron, drove a taxi in Chicago, and sold municipal bonds. In 1969, Cayne was playing bridge full-time in New York City. He was an excellent player, eventually achieving Grand Life Master status. He met Alan Greenberg at the bridge table. Greenberg, impressed by Cayne's analytical mind, hired him as a stockbroker at Bear Stearns. Cayne rose through the ranks, becoming a partner, then president. His management style was cautious and consultative, very different from Greenberg's impulsive volatility. Cayne avoided big bets, consulted widely before making decisions, and focused on steady growth. These qualities made him seem like a safe choice. But Cayne had a critical flaw. He was a part-time chief executive. He played golf every Thursday and Friday, taking a $1,700 helicopter from Manhattan to his club in New Jersey. He competed in high-level bridge tournaments, sometimes disappearing for days. And when crisis struck, he often was not available. For now, in the mid-1990s, that did not matter. The markets were soaring. Bear Stearns was profitable. And the seeds of disaster, planted in the firm's growing mortgage securities business, were still underground. The period from 1993 to 2001 was one of the great bull markets in American history. The S&P 500 rose from 435 in January 1993 to 1,527 in March 2000. A 251% gain in 7 years. Economic growth averaged 3.8% annually. Unemployment fell from 7.5% to 4%. Inflation remained subdued at 2 to 3%. The federal budget swung from massive deficits to surpluses. Several forces drove this expansion. The commercialization of the internet created entirely new industries and transformed existing ones. Companies like Amazon in 1994, eBay in 1995, and Google in 1998 emerged. Netscape's initial public offering in August 1995 symbolized the new era. The stock opened at $28 and closed at $58 on its first day. The fall of the Berlin Wall in 1989 and the collapse of the Soviet Union in 1991 opened vast new markets. China's economy was growing at 10% annually. American corporations expanded globally, accessing cheap labor and new consumers. Alan Greenspan, appointed Fed chairman in 1987, kept interest rates moderate. The Fed funds rate averaged 5.1% during the 1990s. Low enough to fuel growth but high enough to maintain credibility. When the Asian financial crisis threatened contagion in 1998, Greenspan cut rates 3 times, signaling the Greenspan put. The Fed would support markets in crisis. Derivatives, complex securities, and mathematical models transformed finance. Long-term capital management, a hedge fund run by Nobel Prize winners, used leverage and quantitative models to generate extraordinary returns before nearly collapsing in 1998. Jimmy Cayne took over as chief executive just as this boom was accelerating. Under his leadership, Bear Stearns pursued several strategies. The firm's equity trading and investment banking divisions grew aggressively. Bear Stearns competed for initial public offerings, mergers and acquisitions, advisory assignments, and institutional trading business. By 1997, the firm was among the top 10 underwriters of United States equity offerings. Bear Stearns became a leading prime broker, providing clearing, lending, and operational support to hedge funds. As hedge funds proliferated in the 1990s, this business exploded. Prime brokerage was ideal for Bear Stearns. It leveraged the firm's clearing infrastructure, provided stable fee income, and required relatively little capital. The mortgage-backed securities business, still relatively small in 1993, became a major profit center. Bear Stearns underwrote mortgage-backed securities for Fannie Mae and Freddie Mac, traded mortgage bonds, and began creating increasingly complex structured products. Collateralized mortgage obligations, stripped securities, and early collateralized debt obligations. This business was lucrative. The spreads were wide, the volumes were growing, and the model said the risks were manageable. More importantly, competitors like Lehman Brothers and Goldman Sachs were making fortunes in mortgage securities. Bear Stearns wanted its share. In September 1998, long-term capital management nearly collapsed. The hedge fund, run by John Meriwether, former Salomon Brothers trader, and advised by Nobel laureates Myron Scholes and Robert Merton, had amassed positions worth $1 trillion using leverage of 25-1. When Russia defaulted on its debt and global bond market seized up, long-term capital management faced catastrophic losses. The Federal Reserve, fearing systemic meltdown, convened a meeting of Wall Street executives to orchestrate a bailout. Goldman Sachs, Merrill Lynch, and about a dozen banks agreed to inject $3.65 billion into long-term capital management. Jimmy Cayne refused to participate. Bear Stearns had been long-term capital management's prime broker, earning millions in fees, and Cayne himself had invested $10 million personally. But he would not contribute to the bailout. His reasoning was, why throw good money after bad? The decision was rational from a narrow financial perspective but destroyed relationships. When it was Bear Stearns' turn on the precipice a decade later, those who remembered Cayne's refusal were less inclined to help. From 1998 to 2000, the stock market entered full mania. The Nasdaq, heavy with technology stocks, surged from 1,500 to 5,048. Companies with no revenue commanded billion-dollar valuations. Day traders quit their jobs to play the market. Every dinner conversation included stock tips. Bear Stearns profited immensely. The firm underwrote initial public offerings for internet companies, knowing many would fail but collecting fees regardless. The equity trading desks churned enormous volumes. The hedge fund clients trading through Bear Stearns' prime brokerage generated record revenue. Cayne's caution evaporated. In 1999, Bear Stearns reported net income of $823 million on revenue of $6.3 billion. The stock price hit $90. Cayne's net worth exceeded $900 million, making him one of the wealthiest chief executives on Wall Street. But beneath the euphoria, cracks were forming. The same internet companies that drove profits were beginning to run out of capital. The business models that seemed revolutionary were proving unsustainable. And in March 2000, the Nasdaq peaked and began a descent that would erase 78% of its value by October 2002. Bear Stearns weathered the dot-com crash remarkably well. The firm had relatively little capital tied up in venture investments. Its bread-and-butter businesses, trading, clearing, prime brokerage, were less affected by the tech collapse than pure investment banking firms. By 2002, as the S&P 500 bottomed at 768, down 49% from its 2000 peak, Bear Stearns was adapting. The firm cut costs, reduced headcount modestly, and shifted focus to fixed income and mortgage securitizations. Businesses that were booming as interest rates fell. The Federal Reserve, responding to recession and then to the September 11 attacks, cut the Fed funds rate from 6.5% in May 2000 to 1% by June 2003. This ultra-low rate environment created a massive refinancing wave. Homeowners refinanced mortgages to lower rates, generating enormous volumes for mortgage securitizers. New home purchases accelerated as monthly payments fell. Bear Stearns, with its growing expertise in mortgage securities, was perfectly positioned for what would become the greatest housing boom in American history, and the catastrophe that followed. The economic landscape of the early 2000s was defined by several interlocking forces. The Fed held rates at 1% from June 2003 to June 2004. This prolonged period of cheap money fueled borrowing across all sectors. Mortgage rates for 30-year fixed loans fell below 5.5%, the lowest in decades. Adjustable rate mortgages offered initial teaser rates as low as 2 to 3%. United States home prices, which had been rising steadily since 1995, accelerated dramatically. The S&P Case-Shiller Home Price Index rose 124% from January 2000 to its peak in July 2006. In hot markets like Las Vegas, Phoenix, and Miami, prices doubled in just 3 years. Home ownership rates reached 69%, the highest in American history. Mortgage lending transformed fundamentally. Traditionally, banks made mortgage loans and held them on their balance sheets, bearing the credit risk. In the new model, lenders originated mortgages, immediately sold them to investment banks, who packaged them into securities and sold them to investors worldwide. The lender no longer cared about credit quality. They earned fees and passed the risk along. As demand for mortgage-backed securities grew insatiable, lenders lowered standards to originate more loans. No doc or stated income mortgages, where borrowers simply declared their income without verification, became common. Ninja loans, no income, no job, no assets, were marketed aggressively. Subprime mortgages, loans to borrowers with poor credit, grew from $65 billion in 1995 to $625 billion in 2005. Central banks in Asia, particularly China and Japan, accumulated trillions in dollar reserves and sought safe, high-yielding investments. European banks, German pension funds, and sovereign wealth funds all bought mortgage-backed securities, trusting the AAA ratings from Moody's and Standard & Poor's. Bear Stearns entered this environment with significant mortgage expertise but relatively conservative positioning. That would change dramatically under the leadership of Warren Spector, the firm's president and co-chief operating officer. Spector joined Bear Stearns in 1983 as a 26-year-old bond trader. He was brilliant, aggressive, and intensely focused on profitability. By the 1990s, he ran the firm's fixed income division. By 2001, he was president. Many viewed him as Cayne's eventual successor. Spector believed mortgage-backed securities represented Bear Stearns' future. The business combined everything the firm did well: trading, risk-taking, quantitative analysis, and client relationships. And the profit margins were extraordinary, far higher than traditional equity or bond trading. Under Spector's direction, Bear Stearns expanded aggressively. Bear Stearns acquired EMC Mortgage in 1994, gaining a platform to originate and service mortgages directly. By 2006, EMC was one of the largest subprime mortgage servicers in America, handling payments for millions of homeowners. The firm built a vertically integrated mortgage business. EMC and partner lenders originated loans. Bear Stearns Structured Products Group packaged them into mortgage-backed securities and collateralized debt obligations. The sales force sold them to investors. The trading desk made markets in the securities. Every step generated fees and spreads. Unlike pure underwriters, Bear Stearns increasingly held mortgage securities on its own balance sheet. The logic was compelling. AAA-rated mortgage bonds yielded 0.25 to 0.5% more than equivalent maturity treasuries. Using leverage of 30 to 1, not unusual for investment banks, that small spread generated returns on equity of 15 to 20%. Beginning in 2003, Bear Stearns became one of the leading underwriters of collateralized debt obligations. Complex securities that pooled mortgage-backed securities and sliced them into tranches of varying risk and return. From 2003 to 2007, Bear Stearns underwrote more than $200 billion in collateralized debt obligations. The collateralized debt obligation structure was elegant in theory. Take a pool of mortgage bonds, some AAA rated, some BBB rated, some lower. Use financial engineering to create new tranches. Senior tranches that absorbed losses only after junior tranches were wiped out. The rating agencies, using models that assumed housing prices never fell nationally, awarded AAA ratings to 80% of collateralized debt obligation tranches. In practice, collateralized debt obligations were catastrophically dangerous. They were opaque, illiquid, and often contained the worst quality subprime mortgages. The loans lenders could not sell any other way. For Bear Stearns, 2005 and 2006 were the best years in the firm's history. In 2005, net income reached $1.87 billion on revenue of $9.15 billion. The stock price hit $136. Bear Stearns ranked among the top 3 underwriters of mortgage-backed securities. In 2006, net income reached $2.05 billion on revenue of $9.16 billion. Return on equity exceeded 20%. The firm employed 14,153 people globally. Assets totaled $350 billion. A stunning figure for a firm that had $100 million in capital just 30 years earlier. Jimmy Cayne's net worth approached $1.5 billion. Warren Spector owned Bear Stearns stock worth approximately $289 million. Ace Greenberg, now 79 and still chairman of the executive committee, was worth over $1 billion. But the risk metrics were flashing red. Bear Stearns' leverage ratio, total assets divided by equity, reached 33 to 1 by late 2006. This meant that a 3% decline in asset values would wipe out 100% of shareholder equity. For comparison, in the 1990s, leverage typically ranged from 20 to 1 to 25 to 1. An increasing percentage of Bear Stearns' balance sheet consisted of mortgage securities that could not be easily sold. Level 3 assets, those valued using models rather than market prices, grew from $2 billion in 2003 to $28 billion by 2007. Bear Stearns borrowed massive amounts in the overnight repo market, taking cash from counterparties and pledging securities as collateral. This funding was cheap and abundant, but it depended entirely on confidence. If counterparties doubted Bear Stearns' solvency, they could refuse to roll over the loans, triggering a liquidity crisis. The firm's fortunes were increasingly tied to housing. If home prices fell, the mortgage securities would decline in value, the collateralized debt obligations would suffer losses, and Bear Stearns' balance sheet would take a direct hit. In 2003, Bear Stearns Asset Management launched 2 hedge funds that would ultimately trigger the firm's collapse. The Bear Stearns High-Grade Structured Credit Fund, launched in late 2003 and managed by Ralph Cioffice, a 22-year Bear Stearns veteran, invested in AAA and AA-rated mortgage-backed securities and collateralized debt obligations, using leverage of approximately 10 to 1. The strategy seemed safe. Buying highly rated securities and collecting the yield spread. The fund performed well initially, returning 12.9% in 2004, 10.4% in 2005, and 9.6% in 2006. By early 2007, the fund had grown to $925 million in assets. The Bear Stearns High-Grade Structured Credit Enhanced Leverage Fund, launched in August 2006 and also managed by Autopsy, pursued the same strategy but with higher leverage, approximately 16-1. The pitch to investors was double the returns of the original fund with only moderately higher risk. The Enhanced Leverage Fund grew quickly, attracting $600 million in capital by March 2007. Bear Stearns itself invested $45 million, and senior executives personally committed millions. Both funds held massive positions in collateralized debt obligations, particularly the riskiest tranches. But because the tranches were rated AAA by Moody's and Standard & Poor's, the funds could borrow against them cheaply and lever up. It was a circular logic. The high ratings enabled leverage, and the leverage magnified returns, which attracted more capital, which enabled larger positions. Ralph Autopsy became a hero within Bear Stearns. He was generating 10% plus annual returns in boring, safe mortgage securities. Warren Spector praised the funds publicly. Jimmy Cayne mentioned them in earnings calls. No one asked the fundamental question. If these securities were so safe, why did they yield 5 to 6% when treasuries yielded 4%? What risk was being compensated that the models were not capturing? In January 2007, Bear Stearns stock hit $172.61, its all-time high. The firm's market capitalization reached $20 billion. Investment banking revenues for fiscal year 2006 had reached a record. The mortgage business was still generating enormous profits. Across Wall Street, confidence reigned. The S&P 500 stood at 1,424. The Dow had crossed 12,500. Unemployment was 4.5%. Economic growth for 2006 was 2.7%, solid if not spectacular. But beneath the surface, the housing market was cracking. Existing home sales peaked in September 2005 at an annual rate of 7.25 million units. By January 2007, they had fallen to 6.44 million. The month's supply of homes for sale was rising steadily, reaching 7.3 months in December 2006, well above the healthy level of 5 to 6 months. Borrowers who had taken out subprime mortgages in 2005 to 2006 with low teaser rates were seeing their rates reset upward. Many could not afford the new payments. Delinquencies were spiking. New Century Financial, one of the largest subprime lenders, announced in February 2007 that it was facing financial difficulties. By April, it would file for bankruptcy. Bear Stearns' internal risk managers were raising concerns about the hedge fund's positions. The mortgage securities the funds held, particularly the BBB-rated tranches of subprime collateralized debt obligations, were showing signs of stress. Prices were falling. Liquidity was evaporating. In March 2007, Warren Spector received a memo from Bear Stearns' risk management team warning that the hedge fund's portfolio contained increasingly difficult-to-value securities and that the funds faced potential total loss scenarios if the housing market continued to deteriorate. Spector forwarded the memo to Autopsy with a note, "Ralph, we should discuss." They never did discuss, not seriously. The funds continued operating as before, even adding new positions as prices fell, averaging down in a bet that the market would recover. It was the fatal error that would bring down both the funds and the firm. By April 2007, the high-grade structured credit enhanced leverage fund was down approximately 6% for the year. The original high-grade fund was down 3%. These were supposed to be safe, boring funds investing in AAA-rated securities. Investors began asking questions. Ralph Autopsy assured them the losses were temporary, that the market would stabilize, that the securities remained fundamentally sound. Bear Stearns backed him publicly. But privately, the situation was deteriorating rapidly. The mechanics of the collapse followed a predictable pattern. The market value of the fund's collateralized debt obligation holdings fell as subprime mortgages defaulted at accelerating rates. The funds had borrowed heavily from major banks, Merrill Lynch, Goldman Sachs, JP Morgan, Deutsche Bank, using the collateralized debt obligations as collateral. As collateralized debt obligation prices fell, lenders demanded additional collateral or cash, margin calls. To meet margin calls, CFOs needed to sell securities. But in a declining market, selling drove prices lower, triggering more margin calls. As word spread that Bear Stearns funds were distressed sellers, potential buyers disappeared. Even AAA-rated securities became unsaleable. The market was freezing. Investors in the funds, seeing losses and reading news reports, submitted redemption requests. But the funds could not sell assets to meet redemptions. There were no buyers. On June 7, 2007, Bear Stearns announced that the Enhanced Leverage Fund had lost 23% of its value in April. The firm also announced it would provide a $3.2 billion credit line to prevent the funds from collapsing entirely. But the credit line was too little, too late. On June 20, Merrill Lynch seized $800 million in securities from the funds and attempted to auction them. The auction failed catastrophically. There were almost no bids. The few bids that came in were 30 to 50% below the security's stated value. If Merrill's auction prices were accurate, the funds were not just impaired, they were insolvent. And if these AAA-rated securities were worth 50 cents on the dollar, what about the trillions of dollars in similar securities held by banks, insurance companies, and pension funds worldwide? In July 2007, as the situation became hopeless, Bear Stearns made a fateful decision. The firm would not bail out the funds. Jimmy Cayne and the executive committee concluded that injecting more capital would create moral hazard and expose the firm to unlimited losses. On July 31, 2007, Bear Stearns announced that both hedge funds had lost nearly all their value and would be liquidated. The high-grade fund was down 91%. The Enhanced Leverage Fund was down 100%. Investors lost approximately $1.6 billion. Bear Stearns' own investment, $45 million in the Enhanced Leverage Fund, was wiped out. More importantly, the world now knew that AAA-rated mortgage securities could become worthless, that mathematical models had failed catastrophically, and that the housing crisis was far worse than anyone had admitted. The Bear Stearns hedge fund collapse triggered a chain reaction across global financial markets. Suddenly, investors questioned the value of all mortgage-backed securities. The asset-backed commercial paper market, a critical source of short-term funding, shrank by $300 billion in August 2007 alone. Banks became afraid to lend to each other, uncertain about who held toxic mortgage securities. On August 17, 2007, the Federal Reserve cut the discount rate by 50 basis points to 5.75%, signaling its willingness to provide emergency liquidity. It was the first cut since 2003 and a tacit admission that the financial system was in crisis. BNP Paribas froze redemptions from 3 investment funds worth €1.6 billion, citing inability to value mortgage securities. The German bank IKB reported massive losses on subprime exposure. Countrywide Financial, one of America's largest mortgage lenders, narrowly avoided bankruptcy by securing an $11 billion credit line from Bank of America. In the aftermath of the hedge fund disaster, Bear Stearns faced 3 critical problems. Bear Stearns still held billions in mortgage securities and collateralized debt obligations on its own balance sheet. As values fell, the firm faced growing write-downs. In the third quarter of 2007, Bear Stearns wrote down $700 million in mortgage-related assets. The market suspected, correctly, that more write-downs were coming. The hedge fund collapse destroyed Bear Stearns' credibility in risk management. If the firm could not spot problems in its own funds, managed by a 22-year veteran, what other landmines lurked on the balance sheet? Warren Spector, the architect of Bear Stearns' mortgage strategy, was fired on August 5, 2007. Jimmy Cayne remained chairman and chief executive, but he was increasingly absent, playing golf and bridge while the firm burned. In January 2008, Cayne would step down as chief executive, remaining chairman, and be replaced by Alan Schwartz, the head of investment banking. A man with no trading or risk management background, taking over during an existential crisis. In the third quarter of 2007, ended August 31, net income fell to $171 million, down 61% from the previous year. Mortgage-related write-downs totaled $700 million. In the fourth quarter of 2007, ended November 30th, Bear Stearns reported its first quarterly loss since going public. $854 million, driven by $1.9 billion in mortgage-related write-downs. The stock, which had been at $172 in January, closed November at $88. For fiscal year 2007, Bear Stearns reported net income of just $233 million, down 89% from 2006 record $2.05 billion. Return on equity collapsed to 1.1%. The firm announced 1,250 layoffs. But Bear Stearns insisted it was adequately capitalized. On December 20, 2007, Alan Shorts told CNBC, "There is no liquidity crisis. There is an asset pricing problem which we are addressing." He was catastrophically wrong. In January 2008, the broader market was in free fall. The S&P 500 fell 6% in January. Financial stocks were crushed. Citigroup, Merrill Lynch, and UBS all reported massive fourth-quarter losses. The Fed, recognizing the severity of the crisis, cut the Fed funds rate from 4.25% to 3.5% in two emergency moves. Bear Stearns reported preliminary first-quarter 2008 earnings on January 17. Net revenues of $1.1 billion, operating expenses of $1.15 billion, barely breaking even. But Shorts emphasized that the firm had $17 billion in cash and unencumbered assets. In February 2008, Bear Stearns stock fell to $69, then $60, then $55. Hedge fund clients were quietly moving their accounts to other prime brokers. Counterparties were demanding more collateral on repo transactions. Credit default swaps, insurance against Bear Stearns default, were trading at levels suggesting a 25% probability of bankruptcy within a year. On February 28, Shorts announced he was seeking strategic alternatives, potentially including a sale of the company. The announcement was intended to show strength but had the opposite effect. It signaled desperation. Alan Shorts appeared on CNBC Squawk Box to reassure markets. "Our liquidity position has not changed at all. Our balance sheet has not weakened. Our client business is strong." The statement was technically accurate but incomplete. Bear Stearns had $18.1 billion in cash on Monday morning. The firm's daily funding needs, money required to finance trading positions and ongoing operations, were approximately $60 to $70 billion, borrowed overnight in the repo market. Everything depended on counterparties' willingness to continue lending. And that willingness was evaporating. Repo market counterparties began refusing to roll over Bear Stearns funding. Money market funds that had purchased Bear Stearns commercial paper declined to renew. Prime brokerage clients accelerated their departures. By Tuesday afternoon, Bear Stearns had lost $15 billion in liquidity, not through losses on assets, but simply because counterparties demanded their cash back. Sam Molinaro, Bear Stearns' chief financial officer, made a frantic call to the New York Federal Reserve. "We are going to run out of cash tomorrow." Bear Stearns' cash balance fell to $2 billion, less than one day's funding needs. Without a major injection of capital, the firm would fail on Thursday morning. The Federal Reserve convened emergency meetings. The choice was stark. Let Bear Stearns fail, triggering potential systemic collapse, or arrange an emergency rescue. Timothy Geithner, president of the New York Fed, worked with J.P. Morgan Chase to structure a solution. At 9 p.m. on March 12, Bear Stearns and J.P. Morgan issued a joint press release. J.P. Morgan would provide emergency funding, backstopped by the Federal Reserve, to keep Bear Stearns operational. The release was intended to buy time for a more permanent solution. Instead, it confirmed Bear Stearns' death. Rumors swirled. Bear Stearns was insolvent. The Fed was orchestrating a fire sale. J.P. Morgan was the only bidder. Behind the scenes, J.P. Morgan Chase chief executive Jamie Dimon and his team were conducting furious due diligence on Bear Stearns' balance sheet. What they found was terrifying. Bear Stearns had approximately $30 billion in illiquid mortgage securities, hundreds of billions in derivatives exposure, and counterparty relationships that could trigger cascading defaults across the financial system. Dimon did not want to buy Bear Stearns. But the Federal Reserve made it clear. J.P. Morgan would receive extraordinary support. The Fed would provide $30 billion in non-recourse financing, meaning J.P. Morgan would not bear the risk on Bear Stearns' worst assets. At 7 p.m. on Sunday, March 16, J.P. Morgan Chase and the Federal Reserve announced the terms. The price was $2 per share, valuing Bear Stearns at $236 million. J.P. Morgan would acquire 100% of Bear Stearns stock. The Federal Reserve would provide a $30 billion non-recourse loan secured by Bear Stearns' mortgage securities. The deal would close immediately to prevent Bear Stearns' bankruptcy. $2 per share. The stock had closed Friday at $30. In January 2007, it had been $172. Bear Stearns' headquarters building at 383 Madison Avenue was valued at $1.2 billion, 5 times the entire purchase price. Jimmy Cayne, whose Bear Stearns stock had been worth $1.5 billion in 2007, so his holdings collapsed to $11 million. Thousands of employees who had received stock-based compensation watched their savings evaporate. Bear Stearns' board, facing shareholder outrage, negotiated with J.P. Morgan to raise the price. On March 24, the firms announced a revised offer. $10 per share, or $1.2 billion total. J.P. Morgan also agreed to assume $1 billion in Bear Stearns' liabilities. The revised price provided nominal vindication but did not change the fundamental reality. Bear Stearns had ceased to exist as an independent company. On May 29, 2008, shareholders approved the merger. On May 30, Bear Stearns was absorbed into J.P. Morgan Chase. 85 years after Joseph Bear, Robert Stearns, and Harold Meyer opened their small trading house in Lower Manhattan, Bear Stearns disappeared. Bear Stearns' leverage ratio reached 35-1 by late 2007. This meant that a 2.9% decline in asset values wiped out 100% of equity. While other firms also used high leverage, Bear Stearns had less capital cushion than competitors like Goldman Sachs, which maintained a stronger balance sheet, or Morgan Stanley. By 2007, Bear Stearns had approximately $50 billion in exposure to mortgage-backed securities, collateralized debt obligations, and related derivatives. When the housing market collapsed, this concentrated bet became catastrophic. Diversified firms like J.P. Morgan or Bank of America could absorb mortgage losses from other profitable business lines. Bear Stearns could not. Bear Stearns funded long-term, illiquid assets, mortgage securities, with short-term, overnight borrowing, repo funding. This maturity mismatch meant the firm was perpetually vulnerable to a run. When counterparties lost confidence, Bear Stearns had no backup funding source. The June 2007 collapse of the two mortgage hedge funds was not just a $1.6 billion loss. It was a signal to the market that Bear Stearns' risk management had failed catastrophically. The reputational damage made counterparties nervous months before the final crisis. Jimmy Cayne's part-time approach to running the firm during a crisis was disqualifying. Alan Schwartz, who took over as chief executive in January 2008, lacked the trading background to understand the risks on Bear Stearns' balance sheet. Warren Spector, who did understand, had been fired. The firm entered its existential crisis without experienced crisis leadership. Bear Stearns' culture, aggressive, risk-taking, focused on short-term profits, served the firm brilliantly in equity and bond trading. But this mentality was catastrophically unsuited to illiquid, complex mortgage securities. You cannot trade out of a collateralized debt obligation position the way you can trade out of IBM stock. Bear Stearns never adjusted its approach to match the different risk profile. Bear Stearns paid enormous bonuses based on short-term profits without clawback provisions for subsequent losses. Ralph Cioffice, the hedge fund manager, earned millions in fees before the funds collapsed. Traders earned bonuses on mortgage profits in 2005 and 2006, even though those profits would turn into catastrophic losses in 2007 to 2008. This compensation structure encouraged excessive risk-taking with no accountability. Bear Stearns had been so successful for so long, surviving the 1929 crash, the Depression, every subsequent crisis, that the firm developed an institutional arrogance. When risk managers raised concerns, senior executives dismissed them. "We have seen worse" became a dangerous mantra. Bear Stearns' refusal to participate in the 1998 long-term capital management bailout created lasting resentment on Wall Street. When Bear Stearns needed help in March 2008, other firms were less inclined to provide it. Several former Wall Street executives later admitted that they viewed Bear Stearns' collapse with some satisfaction, a settling of scores from 1998. Several factors made Bear Stearns uniquely vulnerable compared to larger competitors. Bear Stearns was the fifth largest investment bank, with $395 billion in assets at peak. Goldman Sachs had $1.1 trillion. J.P. Morgan had $1.6 trillion. Size matters in financial crises. Larger firms can absorb losses that would kill smaller competitors. Commercial banks like J.P. Morgan and Bank of America had stable deposit funding from retail customers. Investment banks like Bear Stearns relied entirely on wholesale funding markets, which disappeared in crisis. Bear Stearns' Tier 1 capital ratio was approximately 10.5% in late 2007, adequate by regulatory standards but below competitors like Goldman Sachs at 14% and J.P. Morgan at 12%. Goldman Sachs had a massive asset management business generating stable fees. Morgan Stanley had a large retail brokerage acquired from Dean Witter. Bear Stearns was more purely a trading house, making it vulnerable when trading profits disappeared. Bear Stearns was simply first. In September 2008, 6 months after Bear's collapse, Lehman Brothers would fail entirely. Merrill Lynch would be acquired by Bank of America. AIG would require a government bailout. Washington Mutual and Wachovia would collapse. And Goldman Sachs and Morgan Stanley would convert to bank holding companies to survive. Bear Stearns' collapse was the opening act of a much larger systemic crisis. The S&P 500 fell 2.5% on March 17, 2008, the day after the Bear Stearns sale was announced. Financial stocks crashed. Lehman Brothers fell 15%, Morgan Stanley fell 11%. Credit default swap spreads widened across the banking sector. But the real impact was psychological. If Bear Stearns, a firm that had survived 85 years, could disappear in a weekend, no institution was safe. The assumptions that underpinned modern finance, that markets were rational, that models accurately captured risk, that diversification provided protection, had been shattered. The Federal Reserve's decision to rescue Bear Stearns via J.P. Morgan was unprecedented. Never before had the Fed provided financial support for a non-bank investment bank. The action was justified as necessary to prevent systemic collapse, but it created moral hazard, the expectation that the government would bail out failed financial institutions. 6 months later, when Lehman Brothers faced a similar crisis, the government chose not to rescue it, triggering the most severe phase of the financial crisis. The inconsistent approach, save Bear Stearns, let Lehman fail, amplified market chaos and became a subject of intense debate. Bear Stearns employed approximately 15,500 people when it collapsed. Most were retained by J.P. Morgan initially, though subsequent layoffs reduced headcount significantly. For many employees, particularly those with stock-heavy compensation, the financial impact was devastating. Retirement savings evaporated. Stock options became worthless. The human cost extended to Bear Stearns retirees, who saw pension investments in company stock collapse. Alan Greenberg, who had warned about mortgage risks but was ignored, lost hundreds of millions in net worth but remained financially comfortable. Junior employees and support staff suffered more severe consequences. Bear Stearns' collapse was the first domino. The crisis that followed included Lehman Brothers filing for bankruptcy in September 2008, the largest in United States history, with $639 billion in assets. Merrill Lynch was acquired by Bank of America in an emergency weekend sale for $50 billion in September 2008. AIG received an $85 billion government bailout in September 2008, eventually rising to $182 billion. Washington Mutual was seized by regulators and sold to J.P. Morgan in September 2008, the largest bank failure in United States history. Goldman Sachs and Morgan Stanley converted from investment banks to bank holding companies in September 2008, accepting Fed regulation to survive. In October 2008, the federal government injected $700 billion into the financial system through TARP to prevent complete collapse. The total cost of the financial crisis is estimated at $10 to $15 trillion in lost wealth. The unemployment rate reached 10% in October 2009. 9 million Americans lost their homes to foreclosure. The crisis triggered the Great Recession, the worst economic downturn since the Great Depression. Bear Stearns was instrumental in creating the securitization market that transformed mortgage lending. The firm's structured products group helped pioneer collateralized debt obligations in the late 1990s and became a leading underwriter in the 2000s. These innovations, which seemed to spread risk and create liquidity, ultimately concentrated risk in ways that models never predicted. Bear Stearns both created and was destroyed by the monster of structured finance. Bear Stearns represented the purest expression of Wall Street's trading culture. Aggressive, quantitative, focused on edges and spreads. For 80 years, this culture was an asset. The firm survived crises that destroyed more conservative competitors because traders understood risk and could react quickly. But when leverage and complexity exceeded a certain threshold, the trading mentality became a liability. You cannot trade your way out of a systemic crisis. Bear Stearns was the last major independent firm still carrying the culture of the 1920s to 1960s. When partnerships dominated, when personal capital was at risk, when traders and partners worked side by side on the floor. The firm went public in 1985 but never fully embraced corporate culture. Partners still thought of Bear Stearns as theirs. That culture, scrappy, merit-based, indifferent to pedigree, had enormous strengths. But it also fostered hubris and resistance to outside oversight. When Bear Stearns collapsed, it represented not just the failure of one firm but the end of a particular vision of Wall Street. Independent, risk-taking, trading-oriented investment banks. After 2008, the surviving investment banks became bank holding companies, subject to commercial bank regulations, protected by deposit insurance and Fed support, but also constrained by capital requirements and leverage limits. The swashbuckling era was over. Bear Stearns did not fail because its assets became worthless. Even the mortgage securities had some value. The firm failed because it ran out of cash when counterparties demanded their money back. In modern finance, liquidity risk, the risk that you cannot sell assets or borrow money when needed, is often more dangerous than credit risk. No firm can survive a run, no matter how strong its long-term assets. When Bear Stearns lost $17 billion in liquidity between Monday, March 10 and Wednesday, March 12, 2008, the firm's assets had not declined in value by that amount. Counterparties simply refused to continue lending overnight. The lesson is, maintain multiple sources of stable funding and never rely entirely on fickle wholesale markets. Bear Stearns bet the firm on mortgage-backed securities. When housing collapsed, there was no diversification to cushion the blow. This violated a fundamental principle the firm's founders had understood. Never let one bet, one market, or one client determine your survival. In contrast to Bear Stearns' mortgage concentration, J.P. Morgan Chase's diversified business model, commercial banking, credit cards, asset management, investment banking, allowed it to absorb mortgage losses that would have killed a pure trading house. Diversification is not exciting, but it is survival insurance. The trading culture that made Bear Stearns successful for 80 years became destructive when applied to illiquid, complex securities. A culture of aggressive risk-taking works brilliantly in liquid markets where you can exit positions quickly. It is catastrophic in illiquid markets where positions cannot be unwound. Ralph Cioffi's averaging down strategy in the hedge funds, buying more mortgage securities as prices fell made perfect sense in a trading context where you could wait for prices to rebound. But with illiquid collateralized debt obligations and escalating margin calls, the strategy accelerated losses. The firm never adapted its culture to match the different risk profile of its mortgage business. Bear Stearns paid massive bonuses based on annual profits without clawback provisions for subsequent losses. This created asymmetric incentives. Heads you get rich, tails the shareholders lose, but you keep your bonuses. The mortgage securitization team earned bonuses of $50 to $100 million collectively in 2005 to 2006 for deals that generated short-term profits but created long-term catastrophic losses. Those bonuses were never returned. Any compensation system that rewards risk-taking without accountability for consequences will eventually destroy the institution. Bear Stearns was big enough to cause systemic problems but too small to command resources for self-rescue. The firm had $395 billion in assets, enough that its failure threatened the financial system, but lacked the capital base, deposit funding, and global reach of true megabanks. When Goldman Sachs faced similar pressures in late 2008, the firm's larger capital base, $75 billion versus Bear Stearns' $11 billion, diversified revenue streams, and superior risk management allowed it to survive, albeit with government assistance. In modern finance, there may be safety in size, which creates troubling too big to fail dynamics. Bear Stearns built reputational capital over 85 years. The hedge fund collapse in June 2007 destroyed it in weeks. Once the market doubted Bear Stearns' risk management, the firm entered a death spiral. Counterparties demanded more collateral, clients withdrew accounts, and the stock price collapsed, all driven by fear rather than realized losses. On March 10, 2008, Alan Schwartz accurately stated that Bear Stearns' balance sheet has not weakened compared to previous quarters. But the market no longer believed Bear Stearns' assurances. The collapse of trust, once begun, could not be stopped with words. Trust takes decades to build and days to destroy. Jimmy Cayne's absence during the crisis, playing golf and bridge while the firm burned, was more than a public relations disaster. It represented a fundamental failure of duty. Financial crises require constant attention, rapid decision-making, and visible leadership. Cayne provided none of these. During the critical week of March 10 to 14, Cayne was in Detroit at a bridge tournament. He participated in some phone calls but was not in the office directing the response. Compare this to Jamie Dimon at J.P. Morgan, who personally negotiated the Bear Stearns acquisition over a single weekend, or Lloyd Blankfein at Goldman Sachs, who worked around the clock during the crisis. Leadership presence matters. The mathematical models that rated collateralized debt obligations as AAA safe were based on historical data showing that United States housing prices had never fallen nationally. When prices did fall nationally for the first time since the Great Depression, the models were revealed as dangerously flawed. Bear Stearns' risk management relied heavily on value-at-risk models that predicted maximum one-day losses under normal market conditions. But March 2008 was not normal. The correlations assumed by the models broke down. Securities assumed to be independent moved in lockstep. The lesson is, models are useful tools but catastrophically dangerous when treated as truth. The Federal Reserve's rescue of Bear Stearns via J.P. Morgan prevented immediate systemic collapse but created an expectation that the government would bail out failed financial institutions. This moral hazard, the expectation of rescue, encourages excessive risk-taking. After Bear Stearns was rescued, other investment banks assumed they too would be saved if they got into trouble. This assumption proved wrong when Lehman Brothers was allowed to fail 6 months later. The inconsistent approach, rescue some, let others fail, was arguably worse than a clear policy in either direction. Bear Stearns survived the 1929 crash, the Great Depression, multiple recessions, the 1987 crash, the long-term capital management crisis, and September 11th. This history of survival created institutional confidence that the firm could survive anything. The belief was wrong. When risk managers warned about mortgage exposure in 2006 to 2007, senior executives invoked Bear Stearns' history. We have been through worse. But the 2008 crisis was fundamentally different. a wholesale funding crisis combined with a housing collapse that affected the core of the balance sheet. Historical resilience provided no protection. Jimmy Cayne was born in 1934, joined Bear Stearns in 1969, and became chief executive in 1993. At the peak in 2007, his net worth exceeded $1.5 billion. By March 2008, his Bear Stearns holdings had fallen to $11 million. He was 74 years old, had led the firm for 15 years, and watched his legacy and fortune evaporate in days. Cayne never publicly accepted responsibility. In interviews years later, he blamed short sellers, panicked counterparties, and the Federal Reserve's inconsistent crisis response. The failure to acknowledge his own absence and leadership shortcomings damaged his reputation permanently. He died in 2021 at age 87, remembered primarily for the bridge tournaments he attended while his firm collapsed. Ace Greenberg, chairman of the executive committee in 2008, had warned for years about excessive risk-taking in mortgages. He was overruled by Warren Spector and Jimmy Cayne, who saw the mortgage business as the firm's future. At age 80, Greenberg watched the firm he had built over 6 decades disappear. His Bear Stearns holdings, worth over $1 billion in 2007, fell to approximately $58 million after the J.P. Morgan sale. But Greenberg had diversified his wealth over decades and remained financially secure. He died in 2014 at 86, one of the last links to Bear Stearns' glory days. His legacy was a brilliant trader whose warnings were ignored by a firm that had grown too confident. Warren Spector joined Bear Stearns in 1983, rose to president, and became the primary advocate for the firm's mortgage strategy. He believed securitization represented the future of finance and pushed Bear Stearns aggressively into collateralized debt obligations and structured products. When the hedge funds collapsed in June 2007, Cayne fired Spector. It was partially deserved. Spector had overseen the disaster, but also convenient scapegoating. Spector's Bear Stearns stock, worth $289 million in early 2007, eventually became worth less than $15 million. He retreated from public life and rarely gave interviews. The mortgage strategy he championed destroyed both the firm and his own fortune. Ralph Cioffice managed the 2 hedge funds that collapsed in June 2007, triggering Bear Stearns' reputational crisis. He was a 22-year Bear Stearns veteran who genuinely believed the mortgage securities were safe based on AAA ratings and historical data. In June 2008, Cioffice and his colleague Matthew Tanin were arrested and charged with securities fraud for allegedly misleading investors about the fund's condition. After a trial in 2009, both were acquitted. The jury found they had been wrong but not criminally deceptive. Cioffice lost his job, his reputation, and much of his wealth but avoided prison. His story illustrates how conviction in flawed models can lead sophisticated professionals to make catastrophic decisions. Bear Stearns employed approximately 15,500 people in March 2008. Many were traders, analysts, and support staff who had joined believing they were building careers at a prestigious institution. For these employees, often in their 20s and 30s with student loans and mortgages, the collapse was devastating. Stock-based compensation packages became worthless. For 401k accounts heavily invested in Bear Stearns stock evaporated. Career trajectories were derailed. While senior executives lost millions, they generally had diversified wealth. Junior employees often lost everything they had accumulated. This human cost, rarely discussed, was replicated across the financial sector in 2008 to 2009. Today, if you visit 383 Madison Avenue in New York City, you will find a J.P. Morgan Chase office building. The trading floor where Ace Greenberg answered his own phone is long gone. The risk arbitrage desk where fortunes were made and lost has been absorbed into J.P. Morgan's global trading operations. The conference rooms where partners decided the firm's fate in those final days of March 2008 host different meetings for different managers pursuing different strategies. The Bear Stearns name exists only in history books, financial crisis documentaries, and the memories of those who worked there. For the thousands of former employees scattered across the financial industry, the Bear Stearns collapse remains a defining experience. A reminder that no institution is permanent, no success is guaranteed, and hubris is always punished eventually. The firm that survived the Great Depression could not survive the Great Recession. The partners who prided themselves on risk management proved incapable of managing the risks they had created. The culture that valued toughness above all discovered that some challenges cannot be tough talked away. Bear Stearns' legacy is complex. The firm pioneered securitization, block trading, risk arbitrage, and prime brokerage. Innovations that transformed modern finance. It provided opportunities for talented people from non-traditional backgrounds, proving that Wall Street success did not require Ivy League pedigree. It generated enormous wealth for partners, employees, and shareholders over 8 decades. But the firm also epitomized the dangers of leverage, concentration risk, and institutional arrogance. It helped create the mortgage securities machine that nearly destroyed the global financial system. Its collapse required taxpayer support and contributed to a crisis that cost millions of Americans their jobs, homes, and savings. Judging Bear Stearns requires holding both truths simultaneously. The firm was both innovative and reckless, both meritocratic and destructive, both resilient and fragile. Its rise and fall contain lessons for anyone who builds institutions, manages risk, or believes that past success predicts future survival. In the end, Bear Stearns matters because its story is fundamentally human. The firm was not destroyed by market forces or random chance. It was destroyed by decisions made by specific people at specific moments. Jimmy Cayne playing bridge while the firm burned. Warren Spector doubling down on mortgages when prudence demanded retreat. Ralph Cioffi's believing the models when evidence suggested skepticism. Alan Schwartz assuring markets of liquidity that was evaporating in real time. These were intelligent, experienced professionals who made catastrophic errors in judgment. Understanding why they made those errors, overconfidence from past success, cultural blindness to new risks, compensation incentives that rewarded short-term gains, and mathematical models that obscured rather than illuminated reality, helps us understand how smart people build time bombs and convince themselves they are building fortresses. 85 years from founding to collapse. 5 days from adequately capitalized to insolvent. $2 per share for an institution once worth $20 billion. These numbers tell a story, but not the whole story. The whole story is about ambition and hubris, innovation and destruction, success and failure. The eternal cycle of capitalism, compressed into the lifespan of a single firm. Bear Stearns rose from nothing in 1923, dominated Wall Street trading for decades, pioneered financial innovation, survived every crisis for 85 years, and then disappeared in a long weekend in March 2008. It will not be the last firm to follow that trajectory. The forces that destroyed Bear Stearns, leverage, interconnection, complexity, and human overconfidence, remain embedded in modern finance. The names will change, the specific mechanisms will differ, but the pattern will repeat. That is the final lesson of Bear Stearns. Not that this particular firm failed, but that failure is inevitable when risk outpaces understanding, when growth outpaces control, and when confidence outpaces humility. The house that hubris built will always, eventually, collapse. The only question is how much damage the collapse causes, and whether we learn anything from the rubble.